Welcome, everybody, to Stratagem Trades class on portfolio hedging. It's the primer for the mini class that's coming up next weekend. This is going to be a relatively quick class, but it's going to be very, very insightful. When I started my previous company, I wrote 4 books, 2 of them originally. One was The Broken Wing Butterfly, where I introduced the broken wing butterfly to the world. And then the other was the collar book. And I assumed that collars would be probably the most popular topic among students, but it was proven me wrong in that the BWB book took off. I then went into full-blown starting a company after Optionetics closed down and got bought out by the brokerage firm. And I actually introduced portfolio hedging a couple times, but there was not much interest in it. And I think that really the lack of interest in it was people just not understanding the benefit from it. I was new to teaching. I didn't know what students would ask. Or they were so excited about some of the other strategies I was doing that was giving immediate gratification compared to a long-term strategy that it just, collars took a second to other things. This got reinvigorated. This collar phenomenon got reinvigorated when we started the collar section, where we did a call instead of stock in the video. Then we did a put instead of short stock in the video. Then we went in and did a longer term study on PLTR that really got people excited. And then portfolio management just really got even more excited in people's minds, just by accident, really. And I'll explain how it came about in a minute. So we're going to go into this. I think this is going to actually be our signature product long term, which is why I'm bringing out my flying pig again. I sort of abandoned the flying pig when I started Stratagem, and but there's just so much demand and interest that the flying pig is going to be synonymous with portfolio hedging going forward. So let's get going. And before we go any further, I have to go into the disclaimer that just simply says I'm giving out education, not advice. Please read all the disclaimers here and on our website before continuing, as it's required that you agree to all these disclaimers in order to continue with the class. Otherwise, log out, contact the office, and discuss with them. The session is being recorded. Before we go any further, though, I have a couple minutes of housekeeping just for organizational purposes. And it's mostly about the January schedule so that everybody knows how things fall into place. Okay, last week we had a shortened week because of Jimmy Carter's funeral. This week's excitement comes with the mini class primer, which we're doing right now, and the CPI that came out today that sent the S&P up 115 points. Next week's excitement is twofold. We have the inauguration on Monday, which means the markets are closed, not because of the inauguration, but because they would have been closed anyways with Martin Luther King Day. It's just coincidence that we had the inauguration on that same day. And then the mini class next weekend. So we have a busy couple weeks ahead of us. After that comes the Fed, the first Fed meeting. And this could be a really crazy Fed meeting because people pretty much wrote off us having any more rate cuts this year. Perhaps they were speculating we would see one in June because inflation just is not under control yet. Yet today, CPI came out and all of a sudden started having people thinking we may have more rate cuts again. So next week's or the last week of the month's Fed meeting could be a wild one. And then on the 30th, which will be a Thursday, we'll have the collars class as we discuss rolling our call instead of stock into another call instead of stock position and how all that process works, because the following day is the day of expiration for our call instead of stock position in PLTR. And we're going to have all the questions answered before we actually start rolling to avoid confusion. But let's get going with tonight's class. And again, it's going to be abbreviated. I'm going to try to make most of the classes this year 90 minutes. Okay, they're all supposed to be 90 minutes or less. I almost always go to 2 hours, but we're going to try to get it down to an hour and a half and just have more classes this year instead of longer classes. People seem to be able to hold their attention a lot better and appreciate an extra class here and there compared to one that goes on for 2.5 hours. So let's get going. And again, tonight's topic is going to be really a primer for the portfolio hedging class that is on Saturday the 25th, and it's going to be all day, 9 to 4. I'll go longer. I'll have a bonus class, whatever it takes. After this, we're going to start the collar again. We'll be rid of PLTR out of our lives, and we're going to start hedging a portfolio of stocks that you guys pick with indexes in the way I'm going to describe it tonight and in the mini class. The best way to describe what's going to be occurring with this mini class and subsequent pod classes where we're actually managing a collar is via a story. And the whole story really started in the Which Strategy and When class that we had back in November. Serendipity happened. Most of the big things I've ever done in teaching or in trading was serendipity, or at least had a serendipitous element attached to it. The best trade I ever had on probably was right before the Persian Gulf War started, but I had great trades on in the crash, the mini crash, etc. The Russian coup I didn't have anything on, but when it started, I created positions because volatility was through the roof, and all I did was sell a whole lot of volatility at the open, and at the close, volatility went from equivalent 25 down to 12. It got cut in half. And I sold a lot of volatility, thousands of contracts. It was all serendipity. That is sort of how this whole class got reinvigorated again. People weren't even thinking about this. It wasn't even on their radar. But I was in the middle of the Which Strategy and When class, and we ended it at 3 o'clock. A lot of people had to log off because that's all they had allocated for that day. And I said, I'll stay as late as you guys want answering questions. And then from 3 to 4:30 or maybe 5 o'clock, I answered questions. And one of the questions that came up was from a student that got me way off subject. Okay, I was way off the road of what we were talking about with What Strategy and When class, even though it sort of pertained a little bit. And then it came into the whole collar concept. And as exciting as this whole new year is, and it's going to be a crazy year, I can tell already. I mean, we already have the hostages being released. We have like talks of wars ending, all kinds of stuff. We had a huge bearish sentiment leading up to today, and that sort of evaporated. But really, 2024 was just crazy nuts if you think of all the events that were going on. And yet, the thing that stands out to most of my students about 2024 is none of the events that you see on the screen right now, all Jimmy Carter dying or Julian Assange being set free or the guy who killed United Healthcare. Most of the students are remembering PLTR's collar. So that really got a lot of people remotivated about how cool collars can be. If you look at the PLTR graph, we got into it on August 15th, and I'll never forget the day we got into it because it was the day my mother died. So literally, we entered into the trade, and then I got a phone call and ran to the hospital. We ended the trade right at the end of the year, and then we rolled the calls, or rolled into a call instead of stock at the start of the year, and that's where we are right now. Where we are actually at right now, we just rolled again today, so to avoid a little bit confusion, we'll just go over this real quick. We're long the 62 strike call. We originally started out buying the 75 strike call, the 62 call with the 75.63 put spread. Then I rolled down half of the put spreads to the 72 strike to take $2.55 off 2 times, which brought in $510. I was waiting for a bounce. We got a bounce today. And then when we got the bounce, making put spreads cheaper, I bought a $4 put spread today. I rolled my short 63 put down to the 59 strike. So I sold a $3 put spread previously at $2.55 and then bought a $4 wide put spread for 67 cents. And this is our current position. And if you look in Google Sheets, you'll see that all the trades that we've done so far are up there. Now, some people are having problems finding it, but it's under the tab CIS, call instead of stock. So going into tomorrow, this is our position. We have on the giant put spread that's very protective. Our short 89 call, we could probably buy back and actually even buy, say, something like the 76 call a couple times to hedge the 89 call and make it a ratio in case we bounce hard. But there's a lot of things we can do with this thing. We'll discuss that in pod class, not right now. So when we were in the Which Strategy Win class, I brought up who is the world's greatest stock trader. It pertained to the question that was coming in on managing a portfolio. And actually, I think it is Nancy Pelosi. People are typing in Nancy Pelosi. I think Nancy Pelosi is beating Warren Buffett by 300% last year. So, all jokes aside, but when one thinks of who the world's best stock trader is, really 2 minds come to name: Peter Lynch or Warren Buffett. And most people have never heard of Peter Lynch, so Warren Buffett usually comes up as the world's greatest stock trader. I pointed out to people that he is a horrible stock trader. I would bet 75% of my students could pick a stock better than Warren Buffett. If you give him a 2-minute pep talk ahead of time and tell him not to buy into the hype of whatever the current thing is, they could throw a dart at a dartboard and do just as well as Warren Buffett. And that is not to criticize Warren Buffett, because his genius is attributed to his stock picking. And there is genius there. He's a bright guy. He went to Wharton, okay, and he studied under the best at the time. And he does some very sophisticated products and trading. But his genius is not stock picking. As a matter of fact, he says that he would probably, if he was just a regular investor, not even pick stocks, he would just go out and buy an index like the S&P and sit in that. But everyone thinks Warren Buffett's the world's best stock trader. When you ask him what his biggest holding is, everyone comes up and says it's probably Apple. And it used to be Apple, but he liquidated a big chunk of his Apple trading. Throughout most of his career, his biggest holding has been Coca-Cola. As a matter of fact, it's either Coke right now or Bank of America. I'm not sure which. Okay, he might have more Bank of America right now than Coke, but Coke is always at the top of his list. He says he wishes he could buy the whole company. And he probably could. If you look at Coke for the last 2 years, and this graph was done today. Okay, this is a current graph of where we closed tonight. And actually, if you go look at Coke, Coke was down on the day. We had a tremendously bullish day today. And Coke was down. It did not even keep up with the market today. Over the last 2 years, Coke is exactly unchanged. Over the last 3 years, Coke is exactly unchanged. Now, I don't know what his affinity for Coke is, if it's because of the dividend, because it's a great company, because it's a stable company, because he's got memories as a kid of buying Cokes and taking it to the beach and selling them one at a time to make profit. He just is like my dad and addicted to the things. But over the last 2 years, 3 years, Coke has done nothing. Now compare that to the S&P. This is the S&P in the last 2 years. In the last 2 years, we're up 56%. So how does Warren Buffett consistently beat the market when he owns Coke as his major holding that doesn't go anywhere when the market is up 56%? Can you imagine what Coke would be trading at if the market was unchanged or lower? Coke can barely stay with its head above water, even though the market's up 56% in 2 years. Coke is a dog. So why is he staying in it? Does anyone know why he stays in it? Why would you be in this stock? Wouldn't you eventually get out of a stock that year after year after year after year doesn't do anything? It's just a tool to him. It is nothing more than a company that he is pretty confident is not going to zero, and he can use as a tool for his portfolio management that we're going to go through in a little bit. By the end of tonight, you'll see why even Coke he's making money on. again, we're talking about serendipity here of why this class came about, why people are so excited, why this mini class, we're not even talking about. Do you see me talking about it at all? I'm not sending out flyers. I'm not sending out updates. I'm not even bringing it up, and it's almost sold out. As a matter of fact, when I was doing the Which Strategy Won class, there were people not even in the class who were not even students in stratagem, not in our database, that called up that night and said, I heard you might be doing a class on how to trade like Warren Buffett. Sign me up. Where'd you come from? I don't know. But it's serendipity, and so we're going to go with it. During the class, I asked five students. I didn't select. I just said, people shout out, give me 5 names, 6 names, whatever you want. I was purposely as vague as possible. Just give me random stocks and random stock amounts. I don't want you to think that I'm rigging this. And we saved all the texts from that class. So you can see that I was going off of just whatever the students came up with at random. And we picked 5 stocks. And I went relatively fast because it was just an extra credit question. I really tried getting this done in a half an hour, going through the stocks, showing how it's hedged, how it works, everything in a half an hour, which is super fast. To give it real good justice is going to take an entire day. But people came up with Dell, AVGO, NVIDIA, AMD, and Amazon. I said, okay, now pick how many shares of each of these you want. Or pick a dollar amount, and I'll figure out the shares. And this is the actual snapshot of the sheet done in that class. In the center box, you see that somebody shouted out, do 800 shares of Dell. And I think that created like this 800 theme because somebody else said NVIDIA 800, Amazon 700. Maybe they did less because it's a bigger stock. AVGO 800 shares, AMD 800 shares. I said, okay, that's good enough. This is a big portfolio, people. This is a $600,000 portfolio at the time of the class back in November. During the class, these were the prices of the stock. You can go back and look. I'm not making any of these numbers up. And the sum total came out to be just under $600,000 portfolio. So then I asked, what percentage are you willing to absorb of a loss on this? It can be 1%, 2%, 5%. The less of a loss you're willing to absorb, the more the cost of your insurance, just like car insurance. You can have a deductible to lower your rates or no deductible, but your insurance is going to be expensive. Somebody picked 7.5%. We came up with 7.6% out of 7.5% just because of the strike prices lining up at 7.6 and says 7.5 better. And I said, okay, well, we have 800 shares of Dell. The put in Dell, that's 7.5% out of the money, costs $4.05. I actually should go back and grab snapshots of it to verify it before it becomes hard to find. If we buy 8 contracts for 800 shares, hedging just Dell is going to be $3,200. Then we went into NVIDIA with the stock at 141. The put that was roughly 7.5% out of the money was trading for $420. 8 of those was going to be $3,360. Amazon, it's a bigger stock, but it's trading on lower volatility. So lower volatility than NVIDIA. And so even though it's a bigger stock, the puts are cheaper. They were only $1.35 per put. 7 of those were going to cost me $945, and so on. To go into each of these names and hedge means I have to go out and buy 39 puts, and the total cost of those puts was going to be just under $10,000. Coincidentally, I then go out and find an index that we're going to hedge within the SPX. I just started with the SPX because at the time the SPX was 590 or 5908, which is pretty close to the $600,000 portfolio that the students created. And this again, serendipity made the math real easy for people to follow. I only need one put to hedge $590,000 of a portfolio. If I went and bought the put 7.6% out of the money, it was going to be at $54.59. It's going to cost me $8.30 one time. I told people we're in Dell, NVIDIA, Amazon, AVGO, AMD. SPX is probably not the best hedge. I use this one just for simplicity purposes so you can see how it works. But a closer hedge, a more accurate hedge that I would be using, given the stocks that you guys picked, would be the QQQs. Now, the QQQ at the time was trading for $496 and change. To get close to this $600,000 number would require 1,200 shares of the stock when it's at $496. So instead of hedging with one put, I'm going to have to hedge with 12 puts to get me $600,000 of protection. From there, we went 7.6% out of the money and found out those puts were trading for $1.45 per put times 12 puts. It's going to cost me about $2,000 to hedge the portfolio. These were 1 month out in time puts. So here's takeaway number one that started sparking people's interest. If I go and hedge with an index, my puts are going to cost me $1,980. Hedging on a higher volatility by going in and buying these puts in the individual names, having to go in and buy puts in Dell, then having to go in and buy puts in NVIDIA, then having to go through and find puts in Amazon, then AMD. Not only is it laborious and time consuming and a bookkeeping nightmare, but it's going to cost me 5 times as much money because these individual names are trading on a much higher volatility than the indexes. So instead of spending $9,841 to hedge this portfolio, I can go into an index, provided I picked the correct index, and spend 20% of that amount and had the same amount of protection, which is all Warren Buffett does. He cannot go out and hedge Coke with Coke puts. He's too big. There's not enough puts for sale in Coke for him to hedge his Coke position. He just takes his Geico, his Coke, his NetJets, his Burlington Northern, etc., all his stock positions, and treats it as an index and then hedges with an index. From there, there's a lot of things that can be done that makes this such a cool index, or such a cool strategy to play with. We can do many different things here. Now, we don't want to, excuse me, we don't want to spend $2,000 on puts. We'd like to get that money back. Well, we bought puts in the SPX, or we bought puts in the QQQ. We can sell puts in the SPX or the QQQ. The problem is selling calls doesn't really work in an index because of margin purposes. But we can sell a very wide call spread and accomplish the same thing. They'll let us sell call spreads. They won't let us sell calls because of the unlimited risk to the upside, even though we have stock protecting it. The brokerage firms aren't sophisticated enough to trust us, or they're not trusting enough to trust us that we know what we're doing. So we're going to have to sell a wide call spread in the Q or the SPX. That's one thing we can do. And the best way to do that is perhaps a risk reversal. And in the risk reversal class, I touched on doing risk reversals to hedge a stock portfolio, and no one seemed interested. Now, the risk reversal class occurred before we had collars, and the collars, in the money we made in the market up, down in NVIDIA, up in PLTR, etc., I think gave people courage and confidence enough to know that they can do this themselves, and got really excited about it. Then when they saw this, they had to have it. So we can do a risk reversal to hedge, or we can do a couple different things. We can buy the puts in an index because that's where the cheap volatility is. And we can sell calls in the individual stocks. Remember, we own 800 shares of Dell. Now, let's say you only want $2,000 back to pay for your QQQ puts. Well, we only need to sell a couple calls and a few names to get $2,000. For example, we have 800 shares of Dell. We can sell 8 calls. But what if we only sell 2 of the calls for $4? And what if we only sell 2 NVIDIA calls instead of 8 at $4.20? And we sell only 3 calls in Amazon. We can sell up to 39 contracts of calls, but let's say we only sell 7 because we think the market's going to take off to the upside and we don't want to limit our upside. Selling just a couple sprinkles of calls will bring in that $2,000 needed to pay for the puts. Now remember, here's the cool thing. This gets really cool, guys. So watch. 7.6% out of the money. That's where our puts were. We know because of the normal distribution curve that if we're looking at a put that is 7.6% out of the money, and it's trading for, let's say, $2.03, that the call that's about 7.6% out of the money will also be trading for about $2 because of the normal distribution curve of time premium. So here, if all these puts, if we hedged in the individual names and it was going to cost us $9,840, 7.6% on the money, we can sell calls that are 98.41 in credits that are 7.6% out of the money. Here's where it gets even cooler. Now we get rid of the equity puts, hedge with an index that only costs us $1,980. And what do you have? You have a credit. The calls you took in 98.41 and the puts you paid out 1980. So you have a credit of $7,861 every single month coming in. Perfectly hedged. This is the step that gives insight into how Warren Buffett's outperforming the market. You'll see it in a second. So, again, instead of buying equity puts, we buy index puts from 1980. We sell calls at 98.41. What's the takeaway? The takeaway is when we created the $600,000 portfolio, and it could have been a $20,000, $30,000, you're going to get by tomorrow morning a survey where we're going to pick the stocks and the portfolio size. But regardless of the portfolio size, your percent returns will be the same. So it doesn't work for Warren just because he's trading hundreds of billions. As a matter of fact, it probably works worse for Warren than it does for you or me because he is so big, he can't get done what he wants to get done. He has to move markets. And William, I'm going to get to that. So we have three choices on our hedges here. Actually, there's going to be more discussed. There's going to be a lot more than three choices, but just so you guys understand the concept of the big picture, three choices. One, we can do index puts versus index calls or call spreads. We'll be into the trade for zero cost, meaning the hedge doesn't cost anything, but we have virtually unlimited upside profit and a downside that's limited. This is for extremely bullish markets. If we saw a move like today happening once, twice a week, every week, this is probably what I would do. But it's rare. You have to have an opinion. Most of the time, I don't want an opinion because as soon as I get extremely bullish, the market stops going up like this crazy. Choice number two, we can do index puts like the QQQ versus selling a couple equity calls, just enough to offset the cost of the index puts. It gets us dollar neutral, but we have almost unlimited upside potential. We don't have to deal with trying to figure out how to get around margin in an index call sale. So it's a lot easier. Just sprinkle a couple call sales in a couple names to get our money back. Two is probably the easiest way to go. Three, we can do index puts versus equity calls and do it one call for every 100 shares of stock to take in credits every single month. we saw that we took in a $7,861 credit monthly, which is 1.3% monthly credit when you figure out we had a $600,000 account. So what does that mean? This enhances all stock returns by about 16% per year. The credits from your hedges means you're going to make about 16% a year on your hedges if the market doesn't move. This is how a guy like Warren Buffett can have Coke that doesn't move and still beat you and me, who picked a stock like a normal stock, like AMD, that goes up and down, and was up only 14% that year. And then you go and look at what stocks he owns and you scratch your head. How did he make 25% when the market was up 5%? And one of his stocks hasn't even moved. Portfolio management. That brings us to, how do I define portfolio management? This is my definition. It deviates a little bit from what you'll probably find in like Wharton or in Wikipedia or any business school. It is the definition I created based on what I've seen people doing, or the big firms like Goldman Sachs and Morgan Stanley and those guys doing for big customers. Okay. Portfolio hedging is just the process of treating a bunch of stocks. We call them a basket. It's like a shopping basket. Whatever stocks you throw in your basket at checkout, that creates its own index. It is then hedged with an index that closely matches the basket of stocks. And in the mini class, we're going to go about the process of how to select the correct index. You may have a weird group of stocks that, like, we got to go into the Russell or the NASDAQ, and it gets more expensive than, say, the SPX. But you don't mind because the expected returns are going to be greater too. The hedging of the basket can be done in many ways to customize exposure balanced against a debit or credit you want to accomplish. So this is really done by most people to create credits every single month. Why? If you're working under the assumption that you don't know what the market's going to do, you can't beat the market. The market, you can't predict the market. The market's only up 52% of the days in a year. 48% of the days it's down, so it's not straight lines. Why bet that the stock market is going to be up 8% this month? You're better off taking in huge credits every single month. And once in a while, the calls will go in the money and you got to roll them, just like we did with PLTR. Now, even though we're doing both of these hedges simultaneously, you almost have to look at them separately. The put side and the call side. The put side's real easy. William, this is what I said I'd get to. The put hedge is most straightforward. Okay? It's a balance. Everybody's going to have their own thing. Between a naked long put, a put spread, a put butterfly, condor, etc. We'll discuss in the class which one's the best one to do. My thinking is most of the time I'm in a put spread for myself. Most people's stock portfolios or retirement accounts is their biggest investment. You can get fancy with a wide condor or wide butterfly or a dragonfly and stuff. But when it comes down to your biggest investment you have, you want it properly insured. I will switch to a long put when volatility is very low. When volatility is very high because we're falling, then I'll sell another put against it to make a put spread. On the call side, we're going to go in a lot of detail in the mini class. Don't worry about the details. There's a lot of variables here that take too long to discuss. On the call side of the portfolio hedge, this is where things get a little bit complicated in terms of journal entries. Okay. The put hedge is one-stop shopping. But if you got 6 stocks, you may have calls that are in 6 different names. You also have different choices. You can hedge just enough to get your put cost back. If the market is extremely bullish, that may be the route you're going to. If, for example, you think the Fed's going to start easing aggressively and we could be up 10% in the next 2 months, why sell calls? Or the industry, the sector that you're in is on fire at the moment. Let's say you look at your stocks and they're almost all AI stocks for some reason. And all of a sudden AI becomes very hot and everyone's playing AI again. You're not going to want to be short calls in there. You can sell call spreads in the index because that has a finite amount of loss. And it's not going to cap out the profits you can make on your AI stocks. If the stocks are just market perform like most of the time, like let's say you're in just a regular stock like Apple or something, you can just sell Apple calls. If you think the market is overdone or going to just bounce around and you don't have an opinion, you can sell calls even up, meaning you got 300 shares of this stock, you sell 3 calls in Apple. You got 200 shares of NVIDIA, you sell 2 calls in NVIDIA. You have 100 shares in, whatever, United Health, you sell 1 call in United Health. And now you're taking in credits every single month. It's a beautiful thing. I honestly have talked about this class the least amount of any class I've ever done in the last 5 years. And it has the most interest. It's almost sold out. People are just writing me every single day about it, wanting to start immediately. We're not going to start immediately. We're not going to start until after the mini class. I don't want any confusion on this. It takes away the fun. It takes away my time. It causes stress on other people's parts. I want to have fun with this, guys. I want you guys to learn, have fun, and just embrace this. The best way to do it is we're all on the same page by not rushing it. So I'm bringing Sparky back. When you see Sparky, you know we're going to be, it has to do with the portfolio portion of pot or the collars portion of pot. And yeah, that's a new Sparky. We had our artist create a new one. I think he won't work. His hair kind of mimics my hair. He's a pilot. He's got the pilot goggles on. I'm a pilot. He's got the big stogie in his mouth like I always got. They kind of modeled this Sparky after me. Okay. Then after the mini class, we're going to have 5 to 6 month example of the stocks that you guys pick. The survey is going out by tomorrow morning. I apologize for the delay. I was sick. Then my dad got sick. He had to go into the hospital. And not only that, not to blame it on all that, but actually there's other contributing factors to it. The amount of questions coming in about this class has me rewriting the questions for the survey. A lot of people are giving input on what they want this class to be. And I'd say 1 out of 5, 1 out of 10 suggestions that people are making for their own personal desires actually makes sense for the whole group. And so I literally wiped out half of the survey questions and reworded it. So we're going to actually have 2 different surveys going out. A broad-based one tomorrow, by tomorrow morning, maybe tonight, depending on the girls in the office. You know, how much time they have. Pot days, they're busy. But definitely by tomorrow morning. Over the weekend, I'm going to analyze all the data that came in. So get your survey back by Friday night. That's going to put out a second survey of honing down the list of stocks to maybe 10 from maybe 50 different stocks that people are going to suggest. I'm going to take the top 10 and then make people vote on that and whittle it down to 4, 5, 6, or 7, depending on how big these stocks are. You guys pick $400 stocks, we're only going to have 5 stocks. You pick $50 stocks, we can have 8 stocks, and it'll track an index even better. Okay? But here is the power of this class, and it really comes down to compounding. The stock market, look at the blue arrow. Both of these boxes are on an account starting at $30,000. The stock market gets an average of about 10%, 11% returns per year. If you just do market perform, you buy an index and forget about it and get 10% every year, at the end of 10 years, without putting any more money in, no more money is put in, you'll have a balance of $81,000. If we take that same 10% and augment it with another 17% credit from our hedges, bringing in credits, the market does the same 10% return, but we're getting 17% credits from our option hedges. Now you see the same $30,000 at the end of 10 years as $433,000. The only difference is the blue is a 10% return because that's all the stock market gives you. The green is the same 10% the stock market gives you, plus another 15, 17% credit from the calls in the equities, offsetting the puts at a much lower rate in the indexes. Okay? Huge difference. Now, I know there's a lot of you guys out there that are starting to think about retirement a little bit late in life. Life had swings thrown at you. You know, you went in, you're in my divorce club. I'm a member of 2 different divorce clubs. So I know what it's like to lose a lot right before retirement, and all of a sudden you're not going to have as much money as you thought. But let's say you're 10 years away from retirement and all you got is $30,000. If you don't need that 30,000, don't touch it. You get 27% return for 10 years. You're at $433,000 in 10 years. Now, remember, you're going to get 16, 17% from there on out. On average, there's going to be years the market's down, years the market's up more, but on average, the market is up 10% plus your 17% credit from hedging with equities. Now think about it. You have $433,000. It doesn't sound like enough to retire on, but getting 27%, if you just live on that 27% of 433,000, that's 10,000 a month. Retirement, you could consider like a pension check. And question came in, how do you factor in the months when the price goes above the sold call? If the stock goes above the sold call, you're going to do way better than 27%, because you made that month alone 7.5% on the stock in this example, because we went 7.5% out of the money, plus your credit from the call. And now we're just going to roll the call like we were rolling the PLTR calls. So we're going to have to discuss rolling calls in the equities when it gets too close, and that'll be part of the mini class. But that's a good problem to have. It's because you're making more than you should be. Remember, we were talking about this. Great question. We were talking with the market unchanged. We were spending $1,980 on the puts, and we were taking in $9,800 and change on the calls. That brought in like $7,800. The puts were 7.5% out of the money. We'll be playing with different numbers in the mini class, but in this example, the calls were 7.5% out of the money. We weren't even taking into consideration any appreciation on the stock in this example. We just said this is the net credit of our hedge. If the market goes up, say 10% in the stock, and our call is 7.5% on the money, it's going to be 2.5% in the money. We're going to have to roll it, but that means we made 10% on that stock plus the call credit, which, maybe 4% of the price of the stock. So you made 14% on that one particular stock. There's going to be stocks that go nuts, and we're going to have to adjust accordingly. Like if you're in something like Tesla, the bad news is the good news, and the good news is the bad news. With Tesla, the stock can move so much that even if you're relatively far out of the money, the stock can still hit that call. Well, you know what? If you own the stock at 400 and you sell the 450 call and the stock goes through 450, you made $50 on 100 shares of stock. You made $5,000 there alone, and you just roll the calls. Okay, but this, I am talking to my little brother on. Some of you guys have met him at one or two seminars he showed up for to act, help out in the back end and stuff. But he's got the greatest life in the world. He's a ski instructor in Colorado. He just works when it snows. and he just snowboards all day long. That's his passion. He has no stress in his life. He also doesn't make much money, and he's getting older and thinking about retirement. I am going to offer this weekend to him where I'll put 30 grand into the account for him and teach him this. And he'll be in the class with you guys learning this. And when he gets to his mid 60s, and it's time to retire, hopefully he's got $500,000 he can live off of. And it only cost me $30,000. I know Glenda is doing this for her girls who are in their 20s. And Glenda, some of you guys remember Glenda from when she started a couple years ago. Yes, a lot of people were asking, what are you trading? Nothing. Why would I trade? I work for Scott. Let him do it. Well, she's a junkie now. She's got accounts all over the place. January 1st at midnight, she calls up and goes, Scott, can I get my bonus? I want to put in my Thinkorswim account. I can fund this year again. And she's doing the same thing for her girls, trying to get her girls excited. So this slide is actually really cool for some people. Here's another cool slide. Berkshire versus the S&P since 1965. Look at the difference. Okay, guys, I don't know if you notice this. Draw a straight line here versus Berkshire. 10,000 versus what? 150,000. Owning Coke. Nobody drinks that much Coke to cause the stock to go up that much different than the S&P. This graph alone should tell you the strategy does work long term. It doesn't look that sexy because these lines look like they don't diverge that much. But that divergence is crazy when you look at the legend, the y-axis on the left. Any questions so far? Is that in millions? No. I think that was $1 started or something like that. Can we include Berkshire stock? Yeah, they got two different. They got a Class A and a Class B. Class A is crazy expensive. No one's going to be buying it. Class A, I haven't even looked at it yet in a long time because I can do the same thing he's doing even better. I know I'm not buying Coke. If you get a stock that just has a beta of 1 and performs as the market, you'll do better than Berkshire. Because Coke is doing 0. For the last 3 years, the return on capital is 0 if you don't consider dividends. But don't worry, we're going to own the stock so we get the dividends just like Warren Buffett does. But yeah, for you guys with a lot of money, you can do this in Berkshire. Berkshire has options. How do I know what Buffett's doing? Well, Buffett doesn't have to report too much until he goes over certain percentages of a new name or sells certain percentages of a name, or his percent interest in the company goes above or below a certain number. And then you can look at his annual report. Okay, his annual report is a little bit vague, okay, because he doesn't want to tell you what the secret sauce is. You could look at the ingredients on a can of Coca-Cola, but you're never going to be able to make and replicate Coke in your kitchen. A lot of me knowing what he's doing is because I was on the other side of his trades in the SPX pit. And a lot of research and a lot of my friends who happen to know him getting little tidbits from him. Will the mini class be recorded? 1,000%. 1,000%. It will be recorded. Not only is it going to be recorded, but probably half of the people signing up for the class don't even stay in the class. Half of the time that the class is going on, they just go back to the recording. They can't dedicate an entire Saturday to the class, so they'll go in for the first hour or two, the last hour, lunchtime, whenever, and then they eventually get to the recording. I know we have people watching some of these mini class recordings 6, 7, 8, 9 times. Our people in Europe, most of them don't show up to the pod classes at night because of trading, the time zone differences. So almost nobody we have a lot of people in Europe, but almost none of them show up to the class except for maybe Frederico because, um, it's 3 in the morning there. But the first thing in the morning while I'm waking up, they're in listening to the recording. So yes, the class will be recorded. You'll have access to the recording, the slides, and everything, just like every other mini class. Okay, now the last thing that Glenda wanted to let me tell everybody is because she has not gotten this out, and we're really negligent as a company on this. We're not firm enough on prices and length and duration of sales and stuff like that. But for the portfolio hedging class, the deadline for the $4.99 rate is the 29th. She extended it a couple days. There's a couple reasons for that. I'm going to be teaching for another company and about portfolio management that they're going to be offered to be allowed in this class. And I don't want to penalize them by charging a lot more. And so she extended the time or the rate, but I don't even know if when I'm teaching this next class on Friday, if we'll even have seats for them. I'll even bring it up that we're doing a class because we'll probably be sold out. This is the least amount of discussion on the class we've ever had. I never talk about it, and it's selling out faster than anything we've ever had. So I don't know if we'll have any seats by Friday anyway, so this is sort of a moot point. Okay, guys, we're going to have a short class. I'm going to keep this class purposely short because I'm probably going to have a bonus class tomorrow on short butterflies. When is the class? The class is not this Saturday, a week from Saturday on the 25th, 9 a.m. to 4 Chicago time. After Friday, if there are any seats left, price goes to $5.99. So you're saving 20% right there by signing up early. And I told you guys, because most of this was really Like I said, serendipity during the Which Strategy Win class, and I said, I know we can charge $900 for this class and sell it out. I don't care. As a bonus to everybody who was in the What Strategy Win class, we're purposely keeping this price low. This will probably be our most bought class. After it's canned and recorded, it's going to become an annuity for the company. And it is actually delaying the Collars book a little bit because I had no idea there was so much interest in this. Like I said, I taught this, I don't know, 6, 7, 8 years ago, and people fell asleep on me. And I must have either not conveyed how great this is, but Glenda's doing this right now in a remedial form. I mean, she's just learning it, so I'm helping her out with it. So don't ask her how to do it for your account because she'll just say, I don't know, ask Scott. But she's trying to learn it. I'm doing it. I'm going to get my brother to do it so that, you know, when he's in his 60s and can't teach skiing anymore, he's got something to fall back on. But, you know, if he's in 10 years, he can take that 30 grand, get it up to 400, 500 grand, and keep making 25% a year on it. It's 10 grand a month. Rusty balls, you are going to learn this. No problem. You should be able to understand this easier than actually the PLTR. There's more pieces involved in this trade because we're going to have 5, 6 different stocks. So on the surface, it seems like it's more complicated, but it's actually easier once you understand the concept. Michael, you are 100%. This is like collars taken to the next level. But in some ways, I think this is easier. Now, I'm going to be teaching it in a way that I'm assuming it's going to be confusing to everybody. So I'm going to go very remedial, linear, step by step so nobody gets lost. But when you see the big picture, which you just sort of saw today, that's all there's to it. Own a bunch of stocks we like. We hedge the put side in an index where it's cheap. All right, let me show you. Okay, 1 second. Let me show you. Give me a stock name. Any stock name. Don't even make it a crazy wild one. Get out of here, AK. I'll never pick anything you want because you're just going to pick something that's crazy. Nobody's going to want that crap except for you and me. Okay, Apple. That's good as any. Look at Apple. Volatility is what? 29.6. Call it 30. Tesla. Apple's 30. Well, you see, 2 weeks out, it's 83, but that's probably because of earnings. We'll just call it 70. So you're selling calls on a 70, and then we go into the QQQ, and we're buying puts on the 20 vol. Do you see the edge there? Buying 20 vol, selling 70 call vol. That is a greatly oversimplified explanation But that's all you need to understand conceptually what we're doing here. Does trading it too much make you look like Buffett? You know what? 9 out of 10 girls surveyed says he's the most handsome guy on the planet and has a great singing voice. I don't understand it. But if girls find Mick Jagger sexy, this is even better. Because Mick Jagger to me looks just like a bunch of elbow skin. But something about all that money and ability to sing makes him sexy. My guess is if you are as successful as Warren Buffett, no matter what you look like, William, you will look like whatever you want. Okay, guys, like I said, we're going to have a very short class, just a little over an hour tonight, under an hour and a half. I'm going to hopefully do a short butterfly tomorrow. So we'll have another bonus class at the end of the day. For some reason, the butterflies opened up a little early today, which was crazy considering how volatile it was. And then they collapsed again. But I couldn't buy a butterfly 2 hours before the close for 60 cents. If it's like that tomorrow, we're going to sell butterflies. And I'll show you how to hedge it again. Have a great night, guys. I want to thank you. I want to thank everybody at Stratagem. Tomorrow, well, later tonight if the girls aren't busy, but by tomorrow the survey is going to go out. If you don't get it in by Friday night, you're not going to be included in the data that's going to be used to create the second survey. But there's going to be rules and everything going out by January 25th. So that when we start the mini class and we start trading an actual example for 6 months, everybody's on the same page. I've got a spreadsheet that's going to go up ahead of time to keep track of the positions to avoid confusion. We're going to do a lot better job at the spreadsheets. The spreadsheets and the position P&L sheets and position sheets were meant to just keep track of stuff. It's going to be more real time to avoid confusion because there's going to be more moving parts. Easier parts, but more. You guys have a great night. I want to thank you so much. This one's got me juiced. Robert, how you doing? I hope you're feeling good. Everybody have a great day.